Hello and welcome to the February 2023 issue of the Zavitz and Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner, Mark Zavitz. Today, we're going to be quickly going over our model portfolio performance before talking about what drove that performance over the past month. And finally, I'm going to lead you through a demonstration of the CRA My Account system. This is a tax system that's available to all Canadians where they can quickly and easily log in, see all of their tax information, pull all of their tax slips, see information about things like their CPP, their old age security, as well as learn about potential tax credits and benefits that they qualify for from the government. So let's get started. So February was an ugly month. We had a record January month where most of our model portfolios were up between 4 and 5.5%. Looks like we've given back roughly about half of our returns from January. We're still up on a year-to-date basis. Our growth portfolio is up 3.91%. Our moderate portfolio is up 2.91%. Our conservative portfolio is up 2.18%, and our very conservative model portfolio is up around 1.5%. Depending on the model that you're invested in, you roughly have performance roughly in line with this. Sometimes your allocations might be slightly different of some of the different holdings within the model. However, it should be, as a ballpark, roughly in line with the numbers you see on the screen. So what happened over the past month? Well, over the past month, inflation came out of nowhere, completely unexpected. Markets were anticipating and seeing that inflation from maybe about June or July of last year had been steadily coming down. One of the leading drivers of inflation being employment. Employment in North America completely did a 180, and instead of following that downward trend that we saw beginning in June, July, went up huge everywhere. We had a blistering jobs report showing that the economy basically isn't slowing down. What we would have expected and what economists were expecting, jobs numbers that were going to be lower than the December numbers around the 180,000 to 200,000 mark in the States. Instead, we had a jobs report number north of 500,000 in the States. And in Canada, we posted one of the largest job numbers reports ever of all time. Employment increased by 150,000, which was around 130 to 140,000 more than what was expected. To put that into context, we're roughly a tenth of the size of the US from both a population and an economic standpoint. This would be the equivalent to the US gaining over 1.5 million of jobs. So economists don't like to see that. Why don't they like to see that? Well, that's because when more people are working, more people are spending money on goods and services, more people are demanding goods and services, and that entail drives the price of those goods and services up. What else has been happening? Well, we've started to see an uptick over the past year or so, and specifically over the past couple of months, of household debt. And of course, as inflation goes up, we know that rates have been going up. So this means that as debt increases, we fully expect that the cost of that debt that we're all servicing right now is going to become a larger and larger burden. Ugly debt in the United States, being credit card debt, is nearing around $1 trillion. I found this slide interesting, so I decided to insert it. Unfortunately, this is typically debt that's incurred by lower income individuals, but it's worth noting. And in Canada, who is shouldering the burden of our record debt levels? Well, it's mostly millennials and Gen Xers. That's pretty obvious to some, but the reason for that is because that's mostly mortgage debt and HELOC debt. So during your 30s and 40s, that's when you buy your home, and you typically have a large debt balance on your home. So you can see here that these numbers, this is a Globe and Mail report, these numbers might be substantially more than what you would have expected, but they align with the previous slide and the numbers that we were seeing there. But just to, not throw some hyperbole out there, but compare these numbers to 10 years ago, these are, I would say, 2 to 3 times more than what the average debt levels were for Canadians if we were to go back to 2012, 2013. So definitely something to keep in mind as rates go up. That means that the economy is going to slow, primarily because the cost of servicing that debt goes up. So I want to give you an example of what that looks like. So, debts are still low right now, but eventually they are going to start to go up. Why? Well, because when you look at the largest amount of debt in Canada being mortgage debt, well, the cost of a typical average mortgage payment for those Gen Xers and millennials, it's gone up almost 40 to 50% over the past year as rates have gone up. So hypothetically speaking here, if you were to buy $1 million home 2 years ago, you needed to put down a minimum of 20% because that's what you need to do from a CMHC perspective to not have the CMHC insurance. So you have to have a 20% down payment as a minimum. Let's just say you put that minimum down. You had a mortgage of $800,000. Well, that mortgage of $800,000 2 years ago, when your mortgage rate was 2%, well, your mortgage payment was $3,388. Fast forward to today, your average mortgage payment on a 25-year amortization period, which is the average amortization period for mortgages in Canada, is now 5%, and it has gone up to $4,653. That's an increase of almost $1,300 for $1 million home, that same $1 million home. Of course, housing prices, as we've reported previously, have started to come down. But, I don't know anyone whose pay is pacing the amount of the mortgage payment that they owe. So this payment that's gone up for most individuals who have debt, well, it needs to come from somewhere. I don't know how people are going to continue to service these levels, which is why eventually at some point the economy is going to slow down. We don't know when, but it can't continue at this rate because people can't afford homes and they can't afford debt payments at this level. Mark, my perspective is that as rates go up, there's less and less of a probability chance of us having a soft landing. What do you think from a debt perspective? Do you think, if we go up substantially over the next couple of months from a rate perspective, that we could still have this soft landing that everyone's thinking, or no landing at all, or if it's more of an eventuality that we have, a drastic pullback and kind of a harder landing?
Well, Greg, if you were looking at just the debt side of the equation and the amount of disposable income that people are losing for anything outside of debt servicing, that $1,000-1,500 a month that you're talking about that no longer is available for travel and for eating out and buying automobiles and clothing, it's now going to have to go service debt for the next couple of years. If you look at that side of the equation, things are definitely going to slow down, and interest rates shouldn't have to go up too much more. And I think a soft landing is a reasonable expectation. But if you look at the other side of the equation and you look at employment and you look at how sticky employment's been, which is what scared the market in February, when they looked at January employment numbers that you were talking about, and you look at record unemployment and record hiring, it's concerning. And so if you look at the employment side, then you think, well, rates are going to have to go up higher for longer, and that increases the risk of a more difficult slowdown. So it's a tough call. The numbers aren't lining up, which is causing a lot of confusion for economists, right?
Yeah, they aren't lining up, and I guess if we're drawing on the past, in the past, typically what would happen is we would see some slack developing in the labor market as rates go up, but we're not seeing that now. So, like, we're in uncharted waters right now. This has never happened before, and which is making it so challenging for economists to have to make forecasts as to what's going to happen, as well as all the central bankers out there who have to figure out at what level do we raise rates, because eventually the party's going to come to an end, and they're trying not to break the system. But if employment doesn't come down and inflation doesn't come down, it's eventuality that something is going to break. So the next 3 to 4 months, as we head into summer, I think are going to be quite telling. And really, it's going to be almost like the pivotal moment in the economy where we're going to be able to tell for sure if it's a soft landing, a hard landing, no landing at all. I'm leaning more towards, I was leaning towards a soft landing before, but I think if things don't get better from an employment standpoint, like if unemployment doesn't tick up, then and inflation's quite sticky, then we might see a little bit of a harder landing, which isn't a bad thing. It's actually good. We need this. Like, we need inflation to come down. People need to remember that with inflation coming down, it doesn't mean price reversion. Prices aren't going to be coming down if inflation comes down. The only time you get prices coming down is if you have deflation. But disinflation just means that the level of price increases is decelerating. It still means that broccoli is $3 at the grocery store, and that's it. Like, that's the base level. So yeah, it's tough to make a prediction. I mean, we're not trained economists here, even though we study these things on a daily basis. And it's going to be interesting to see as we report in our following months, when we do our monthly updates, what exactly happens. But to throw some optimism into the equation, the good thing is that if you have time on your side, which mostly everyone does, if you're 70 years old right now, you do have a time horizon of, if you made it to 70, typically of 20 years. The odds of, over those 20 years, you having a losing 20-year period are virtually zero. Here's a slide that Mark likes to speak to in our meetings, and we both like to speak to. Mark, throw some color and explain this slide. You're very good at explaining it.
Well, everyone's probably heard this explanation before, but Greg and I do spend a fair amount of time with all our clients trying to establish the time horizon when they're investing money, and talking about the risks, of certain asset classes or certain portfolios making money or not making money over a certain period of time. And when we're dealing with younger clients and longer time horizons, and we have over 10 years, we know based on history that the probability of a positive outcome is 95 to 100%. When it gets challenging is when, we're dealing with short periods of time. Economic cycles can take 4, 5, 6 years, but as we've seen lately, some of them can take 8, 9, 10 years. And trying to create better returns for clients by taking more risk and adding more stocks when we are having possibly to deliver that money to the client in 2 or 3 years can be quite problematic. And so you'll hear Greg and I often encourage clients to, just use high interest savings accounts for short-term, 1-year goals or 18-month goals. Investing is very easy when you're dealing with 10 years or more, because portfolios always make money. So anyways.
And to put into context as well, 99% of our clients are in a balanced portfolio. And if we throw bonds into this mix, like this is just basically stocks. But if we throw bonds into this mix, it's almost 100% at a 10-year mark. So anyway, this is just, to hopefully give you some confidence, because we took a bit of a negative tone talking about debt and a hard landing. But, markets are forward looking, as we've always said. So trying to time this thing in the short run is almost impossible to do. And most everyone that we deal with as clients have longer time horizons, unless there's something specific that we've discussed with you. So it's tax time, and tax slips have been sent out as of yesterday, pretty much by everyone. So your employer, all the way to the investment management companies that send tax slips, most of those have gone out. They usually arrive within the first 2 weeks of March. Sometimes there can be delays from time to time. By the end of March, you should have virtually all of your tax slips. At the onset of this recording, I talked to you about the CRA website, My Account. Now, this is a platform that the government of Canada has built out, where you can view all of your tax slips, all of your tax information. You can see your CPP, OAS, EI information. You can find your contribution information. You can find out about the different benefits you're entitled to. I've got this website open, and I just want to quickly demonstrate A, how I get into the website, and then B, what the website looks like and where I go to find some of my tax information. In fact, most of you wait for physical copies of statements and slips and that type of stuff. I don't even keep that information. I get in and I shred it, because I know that I can log into this platform and everything is going to be organized and available to me online at the tip of my finger. So bear with me 1 second here. Okay, so starting from scratch. Okay, let's just say you open up a Google window. Most people have Google as their default search engine. Type in CRA, My Account, hit enter, gives me a list of links. I go to the My Account for individuals. Now the site might be a little bit slow because it's March 1st and everyone's trying to log in. Once you get to this screen, it's going to ask you to use a sign-in partner. If you've never registered for your My Account before with the CRA online, there's going to be likely two things it's going to ask you. One, it's going to ask you to have your previous notice of assessment ready. And two, if you don't have that ready, it's going to ask you to create your account using a code that they're going to send you by mail. So if you can't give them previous year's tax information because you don't have it handy, the next way to get set up is to provide them with the number that they're going to mail you, and that takes about 2 weeks to arrive. Assuming you get that all sorted, you sign in to the CRA My Account using actually your online banking. Most clients that I'm aware of use online banking. Not everyone. So if you don't use your online banking, there's another way of creating your ID and password. But if you use online banking, you would click on your the sign-in partner link here, and you'll be directed to the sign-in partner's website, where you'll choose your online banking institution or your banking institution. I click on RBC. I'm not going to go through this screen because it contains some of my personal details as well as my password. But from there, you then get access to, hold on, let me pull it up. It logged me out. The CRA website. This is real time, people. So not everything works. Hold on, let me just do this quickly. Oh, okay. Everything signed me out. Bear with me 1 second here. Sign in. Okay. You can see it's all loading. Government of Canada website. And voila, we are in. So here I can see I actually owe $71 in tax. I got reassessed from like 3 years ago when there was a Mackenzie dividend payment that came late, and I'd already filed my taxes. So I can find out if I owe anything. Here you can actually see any uncashed checks, say like GST, PSD checks, say you removed, something got mailed somewhere, you never collected it. Quite useful. When I originally signed into my CRA, my account years ago, I'd found that I had $120 worth of like GST, PSD checks that I never cashed that had been mailed to a previous address in Toronto where I lived. But more importantly to you, and what would be relevant to you today is obviously your RSP, your TFSA contribution limits, but your tax information for when you do your taxes this year. If you click on tax information, it brings you to this screen. From here, you can choose your tax year. I'm going to go to 2022. Now, not all tax slips have arrived yet. They're arriving in the next week or two. Some already have. T3 tax slips are tax slips for the distributions that are paid in my non-registered accounts, interest, dividends of the sort, foreign dividends, etc. So if I want to view all my T3 information for what's already been sent and posted, I can do that here. Oh, great. I see there's a T3 slip available for this mutual fund that I own in my account. This also happens to be a mutual fund that most clients own. And voila, I can see what it is. I own about 35 grand of this fund. I can see over the year it paid an $861 capital gain. Now, this is all tax information that your tax preparer, or if you file your own taxes, you would put into the tax software that you use in order to file your taxes. You can print this off. You don't need the physical tax slips anymore. You don't need to scramble to call the different companies to get them to mail you new copies. All this information is available here. If you're using tax software, there's 4 or 5 different ones available. Listen, if you're filing your taxes yourself and you've got this account set up, most tax softwares over the past year or two will ask you to link your CRA My account to the tax software. And what it'll do is it will pull all of this information for free into the tax software. If you're in your tax software and you've linked the accounts because you've now got your CRA My account set up, and it will file your taxes for you in like 5 minutes. So filing your taxes typically costs $10 to $20. And instead of it being a manual process, an hour or two where you're inputting all these line items, the box values that you're seeing here on a 1-by-1 basis for all the different tax slips. If you've got this thing linked and you say, please upload my CRA My account tax information details, you can file your taxes in like 5 minutes and figure out if you owe or have a refund almost instantly. It's super fast. This again is very useful for not only tax information, but for seeing your contribution information, seeing your CPP, seeing your old age security information, as well as seeing different benefits you might be entitled to based off of your family situation and your income levels. It's highly worth it for you to get set up online. It's very secure. There's a 2-factor authentication that you didn't see me have to verify because I'd already previously logged in. I disabled it so that I wouldn't be sharing some of my personal 2-factor authentication information. But regardless, I highly recommend everyone, all clients, to get set up on this system because you can save money, you can see your information. It's very, very useful. And with that, here's a disclaimer that we're forced to show you. If you've tuned in this long, I say thank you. I hope this was useful. We see better performance ahead, and we look forward to recording our next monthly update for you. If you have any questions or need any help, please feel free to reach out to Mark or I or the team. We look forward to helping you. Thanks, and we appreciate everything. Take care.